Good afternoon and welcome to another one of our live InvestSMART webcasts. My name's Sneddon. I'm the Head of Portfolio Services here at InvestSMART, and today we're going to be taking a closer look at our InvestSMART diversified portfolios. These portfolios use exchange-traded funds to give people broad, diversified exposure across a broad range of different asset classes. So we're going to be going through those today. As we are going through them, please feel free to submit your questions. So just below the little video box there that you see, you'll be able to submit your questions as we go along. After my formal presentation, I'll go to those questions and answer as many as I possibly can. So if anything comes up in your mind, put it down there and we'll get to it later on. Now also, you might notice down in the bottom right hand corner of the screen as well, a little green dot which looks like a bit like a speech bubble. Well, if you click on that, afterwards I'll also be available to have a live chat with you as well, as will some of my other team members if you do have any further questions on from that. So, without any further ado, let's get into today's presentation. Now, the very first slide I'm going to bring up is always my most important slide. It's my disclaimer. So today we're going to be talking about exchange-traded funds. We might even talk about some stocks and who knows what questions you might ask. So today, as we go through this, just keep in mind that this is general information only. It is not tailored at all to your specific circumstances. So what we're going to go through today is general advice only. So keep that in mind, and we might even flick back to this disclaimer if I get a little bit carried away during the question time. So on to this next slide here, just saying what we'll be covering off today. As I mentioned, we'll be looking into the diversified portfolios. But before we go into that, what I want to take a look at is a couple of slides illustrating why diversification is actually so important and why we talk about it so much here at InvestSMART. Now, for those who joined us on our super forum that was in Sydney, Melbourne and Brisbane in the month of May, where we took our advisors Max Newnham and Bruce Bremmel and our CEO Ron Hodge along to answer your questions about the super changes live, you might be familiar with the slides I'm going to go through because it was a bit of this was a part of Ron's a presentation as he presented there. Now, he went through the importance of diversification and also the importance of rebalancing your portfolio. So I'm going to wrap that back up again just very quickly. So for those who weren't able to attend, or maybe just to jog the memory of those who were able to attend, why we do believe it's so important. Then I'm going to go into, of course, the actual holdings of our exchange-traded funds, how we select them, okay, the actual breakdown in our exposure in our InvestSMART core growth portfolio, and then I'll also, of course, wrap up just the general benefits of investing in the separately managed accounts and what separates a separately managed account compared to a managed fund and other different investment products. So let's get started and get into our first few slides. So why does asset allocation actually matter? So as I said, if you were at the presentations that we just did, you would have seen these slides. The next set of slides that I'll be talking about, and we'll go through these relatively quickly because you'll get the gist of them. What it's showing here is the performance breakdown of multiple asset classes. So you can see here on the right hand side of your screen, we've got cash, fixed interest, property, international equities and Australian equities. Okay, you can see what that's represented there by. Australian equities is just represented by the standard index benchmark that a lot of people use, which is the ASX 200. The international is represented there by the MSCI World ex-Australia index. And the property is our ASX REITs. And then we've got fixed interest and we've got cash. Now on the left-hand side of the screen here, you've got diversified portfolios. And these are diversified portfolios, or the ideal diversified mix to make up the Morningstar classification. So we've got the Morningstar diversified aggressive portfolio, the Morningstar diversified growth portfolio, you've got your moderate, your balanced and your conservative. So this very first slide, and we'll go through a few of these, is just showing you that in the last 12 months, the best performing asset class, well, I guess the last 12 months when this slide was made up, because the Australian equity market has pulled back a bit, shows that out of all of these asset classes, you can see here the Australian equities has been the biggest performer in the last 12 months, closely followed by the international equities. Now, if we were to update this for today, I could probably imagine that the international equities has just picked up on it a bit and just nudging out the Australian equities component there. Property hasn't performed as well. Fixed interest doing essentially what we expect it to do there, and cash, of course, trailing behind all of them. Now, the high growth portfolio here, the diversified high growth or the aggressive Morningstar allocation, is a combination of all five, I should say, of those asset classes, but with a heavier slant towards those growth assets. And a growth asset is international equities, Australian equities, and property. Okay, so the more aggressive the setting of the portfolio, the more Australian equities, international equities, and property it's going to have. So you can see, because of that, the high growth diversified portfolio is the highest performer out of our diversified portfolios over this single year. And of course it tapers off with the growth one, the balanced one, of course, both having less exposure to international and Australian equities, but of course having more exposure to those asset classes than compared to, say, the conservative portfolio. Now, we'll skip ahead to the next one. We're now looking over a 2-year time frame here, so not taking into account the last 12 months and the 12 months before that. And you can see things have slightly changed. So over that 2-year period, property has been the biggest contributor to returns. Lagging behind property, you've got international equities and Australian equities, fixed interest, and cash. Now, still, because property and Australian equities and international equities, those growth assets, have been strong performers, you've got the high growth, the diversified growth, and the balanced portfolios still outperforming their moderate and conservative counterparts. That's because they've got a higher makeup of those growth assets. But what happens when we extrapolate it a little bit further out? So let's go to 5 years now, and you can see over a 5-year period, the international equities has been the highest performer, the property has been the second highest, and the Australian equities the third highest. So once again, these diversified portfolios performing as we expect they should. The diversified high growth still leading the way. The moderate growth and the balanced still trailing behind it. Now, and what we can see here as well, over the 1-year period, we had the Australian equities being the best performer. Over the 2-year period, we've had the property. Now the 3-year period, you've got the international. So instead of chasing returns from one asset class to the next as you're going along, perhaps having a bit of a blend of these would have helped you capture most of the upside, as the high growth portfolio here is demonstrating. So now I'm going to go out to the 10-year view, and this gets really interesting because, of course, in 10 years we have quite a few ups and downs. We had a couple of market corrections, and over the 10-year time frame, the best performing asset class has been fixed interest. And so what you see happens here is our conservative and moderate portfolios now and our balanced portfolios are actually outperforming those more aggressive high growth portfolios. And so hence why having this nice diversified mix of asset classes will help you, one, capture the upside from across all the asset classes, but also smooth out your returns. Yes, you're not going to get those big, say, single year returns like the Australian equities and international equities did, but you won't get those big pullbacks as well that they achieved. So you'll have a much more stable portfolio, but you'll also capture growth from all asset classes. So that is why, in a nutshell, we think having diversified portfolio, especially for those who like to say take a bit more of a set and forget style approach, where managing their self-managed super fund and buying direct equities themselves might not be for them. They don't want to spend a couple of hours a day looking at it. Buying into a diversified portfolio can be a much better approach for a lot of people. Now, on this screen as well, you can see things called MERs. Now, that's a management expense ratio. So what that means is basically the fees and costs coming out of the average managed fund that is associated with each of these asset classes here. So basically, when it comes to a diversified portfolio, you can't control what goes in it. You can control what you select, as in I'm going to be moderate, or I'm going to be balanced, or I'm going to be high growth or conservative, but you can control how much you pay. And these are going to eat away at your returns over the years. So make sure when you're looking at these, you go for the cheapest option out there, especially when it comes to the passive approach. In an actively managed approach, the cheapest isn't always going to be the best, but when you're going to a passive exchange traded fund portfolio approach, you have to really pay attention to the fees. And that is why here at InvestSMART, we've been actively reducing our fees. So the average across these is about 1.5% to 1.6% per annum. Our particular portfolios start at 0.77% per annum, so quite a significant reduction there. Now, we'll move on and we'll talk about some rebalancing. So here I've got an image of a portfolio health check. So this is a part of our portfolio management tool. If you've put into your portfolio into our portfolio manager, you'll get it broken down into the various asset classes that you hold. And then you can go and do a health check. So you can actually go and do a score and see just how healthy your portfolio is. So this is a simulation of a balanced portfolio in 2001. And so you can see on our health check, it's getting a score of 98. That's pretty good. Anything above 90 is exceptional. And you can see it's got the mix of asset classes there. Now, what happens now on this next slide is we fast forward to 2007. Now, this portfolio isn't anywhere near as balanced. We haven't done a thing to it. And so what has happened in that time frame? Equities, Australian and international, have run hard. As you know, we're leading up to a certain event here. And you can see the Australian equity component is a much larger percentage of the overall portfolio. The international component is a much larger percentage as well. And you've had cash and fixed interest really squeezed down there. Now, this has deteriorated the overall health score. It's down to 73%. So we've gone from 98 to 73. So now, if we were rebalancing this portfolio, what we would have been doing is, as the Australian equity component and international equity component has run, we would have been forced to trim from those holdings and put that into the positions that are more underweight, so your cash and fixed interest. And what that would do is, of course, improve our overall health score, but also it would prepare ourselves for what's coming up, which is the GFC. So if we didn't do any rebalancing at all, our portfolio is going to take a pretty big hit. Now, even if we did do the rebalancing, of course, as we all know, the GFC was a pretty traumatic time. Even if we did do the rebalancing, our portfolio would still take a hit, but it wouldn't take nearly as much of a hit. And what we would have been doing at the bottom there is, because our shares and Australian shares, international shares, would have taken a hit and become, as a percentage, lesser portion of our portfolio. We would have been tipping out of cash, so the cash that we had rebalanced, okay, so the gains we'd taken in the run-up from 2001 to 2007 and put in cash, we would have then been deploying that back into our then underweight Australian equities and international equities. And what that would have then done is we would have actually been, unbeknownst to us, just by going off the sheer weightings, we would have been investing as the market was falling, okay? And now what we can see is, of course, the market has rebounded and you would have been in a pretty solid position. So that's just in a nutshell why rebalancing to us is so important. So one, getting the diversification right is really important, and secondly, getting the actual rebalancing right. Now, people will ask, how often should they rebalance? Just keep an eye on the weights. You can do it as you go, as the weights increase. Look, if you don't want to be that hands-on, you can say look to do it once a quarter or look to do it once every 6 months. But doing that, do keep an eye on your transaction costs. Of course, you don't want to be chopping and changing too often and incurring brokerage as you're doing it. So that's got to be taken into consideration how often you do rebalance. Okay, so now let's move on and take a look at our actual core growth portfolio. So here I'm opening up the doors and showing you absolutely all of our holdings here in our core growth portfolio. Now, the core growth portfolio is our standard kind of benchmark portfolio when it comes to our diversified portfolios. It's made up of Australian equities, international equities, cash, fixed interest, and property exposure. So getting you broad diversification around those asset classes. So for the Australian equity side of things, we use the iShares, our S&P 200 exchange traded fund. Now these are pure index tracking funds, okay? We are not hand-picking individual managers. We're not using any smart beta exchange traded funds. We want to get the long-term average from these indexes. And so that's why we've chosen the iShares ASX 200 ETF. The other reason why we've chosen that specifically, and this goes into all of the exchange traded funds that we invest in, an exchange traded fund will track the index that it's attempting to track minus the cost of its fees. Okay, so all else being equal, we should see this fund slightly underperform the benchmark just by a fraction. So hence why it's the cheapest out there. It's also one of the biggest out there as well. And the bigger the fund, the less tracking error it should have. That is why we've chosen the iShares ASX 200 exchange traded fund to give us that Australian equity exposure. The management expense ratio, so the actual cost to you as an investor here, you can see is 0.15%. Now, that's our Australian equity exposure. Onto the international, and we've got a couple of different ones here, of course, to get us broad diversification around the globe. We've got the Vanguard All World ex-US index. Now, the reason why we've got ex-US is because we also have an allocation to the iShares S&P 500 exchange traded fund. So what that iShares S&P 500 is giving us exposure to is the top 500 stocks or companies in the US as ranked by their market cap, so the size, and we get all 500, so we get the diversification across there. Now, like our, say, differing from our market, you know, we've got a couple of banks, we've got Woolworths and Wesfarmers, we've got a telco, and really that's about it for our top, and a couple of miners, of course, for our top 10 holdings. Now, if you look at the iShares S&P 500, you've got the names like Google, Amazon, Facebook, etc. So much more dynamic companies at play there, which we're getting exposure to through the iShares S&P 500. Now, getting our European exposure, and certainly in the month of May, this significantly benefited our international exposure, doing approximately 4.6% just for the month, was the Vanguard European Shares ETF. So this tracks the major European markets. Okay, so our international exposure there, it's made up of the Vanguard All World ex-US, the iShares S&P 500, and the Vanguard European markets. Now, the expense ratios, as you can see, are there on the side, and the iShares one is just 0.04% per annum. So really cheap. Why can it be so cheap? It's because, well, there's a fixed cost to running these funds, and the bigger, of course, you get the pool of investments, the lower those costs can be. So just 0.04% approximately on that iShares S&P 500. Now, continuing on, we've got two property exposures within this portfolio. We've got an Australian one, which is Vanguard. So that invests in listed real estate investment trusts, or AREITs, as they're known in the business. Also, then we've got the Van Eck Global Infrastructure. So what that's giving us access to and giving our clients exposure to is global infrastructure assets. So we're talking like toll roads and utilities and gas pipes, etc., all over the globe. Now, when it comes to the cash component that we use, we could go out there and try and find the best term deposits for our clients, or we've done we can do what we've done, which is use AAA, which is Beta Shares High Interest Cash ETF. Now, what these guys do is they go out there and find the best term deposits and put them into this exchange traded fund. So if you were to ever look at the share price, so the price chart of AAA, what you'll see there is it'll look a bit like a saw. So what happens is every single month you'll see the interest accrue, so that's when you see the share price going up. Then it pays out the interest at the end of that month, so it drops, and then it'll continue to accumulate again and then pay it out. So that's what we use for our cash component. They go out there and find the best term deposit rates for us, so we don't have to. Then we have the iShares Core Composite Bonds ETF, which gives us exposure to Treasury and government bonds. Okay, it's quite difficult for an individual to go out there and buy some Treasury and government bonds, hence why getting them wrapped up in one ETF is pretty neat and handy. Then, of course, we can't get there's not too much diversified exposure out in the bonds sector outside of the Treasury and government bonds. So to get actual corporate debt and corporate bonds, we've gone with the Macquarie Income Opportunities Fund. That's just to give us some diversified exposure across that fixed interest segment there. So that's the breakdown of our core growth portfolio. And so people can come into these portfolios and invest $5,000, and what you do is get a complete breakdown, a mixture of all of these as decided, and all individually weighted as decided by our investment committee. And of course, we do the rebalancing as well. So if the Australian equities component was to run, we'd be looking to take profit for you. So that's why a lot of people come and choose to invest in the core growth portfolio as even a bit of an anchor for their portfolio, whilst they go out there with, say, 50 or 60% of the rest of their portfolio, handpicking individual stocks and maybe other managers. So now, here, this next slide here just gives you a bit of an overview as to the actual exposures that we've got currently within this portfolio. The Australian equities component just under 30%, as well as the international equities component. Got a bit of property there, a bit of fixed interest, and a bit of cash. Now, the underlying MER, so the average underlying fees charged by our ETFs here is 0.2% per annum. As I mentioned, our management fee for this particular portfolio starts at 0.77%. So when you're thinking of total cost to you need to add on that 0.2% as well. But of course, our fees start at 0.77. The more you invest, the more they come down. They go down as far currently to 0.65%. We are very avid in looking in time and where possible to be able to reduce these fees. But that will take time, of course, for us to get those down. But right now, we're still very, very competitive compared to our peers. Now, if we look at the international component of this portfolio as well, you can see the different mixture here on this slide of the different exposures that we're getting. We've got America at 47%-ish. Asia, we've got 6.5%. Australia does still make up a little bit of a component of it, of 2.1%. Emerging markets, 4%. Europe is the second highest there at 22 to 23%. Japan at 6.9% and the UK at 8%. Okay, so when you invest directly into our international equities portfolio, this is the exposure that you get. So what we're trying to do with all these portfolios is to give you access to various asset classes for the cheapest possible cost. So if you want to invest in international equities but don't know where to start, I would suggest our international equities portfolio is a pretty good starting point for you. It gives you cheap exposure to a very broad, diversified portfolio of global stocks. Okay. Now, on this next slide, we're talking about core and satellite portfolios. Now, what I mean by core portfolios are the basic diversified portfolios that we have. So our core growth and, say, our diversified income. People can use these 100% solely for their total investing needs, okay, and buy into one of those and set and forget that portfolio. Or they can choose to use it as a bit of an anchor or a benchmark or the core of their portfolio, as the name might suggest. And then they might want to individually go and select, say, something like an actively managed approach with our Intelligent Investor Equity Income portfolio or the Intelligent Investor Equity Growth portfolio to try and get a bit of that outperformance and that enhanced yield coming from the equity income portfolio. So say you've got your core growth there, but you wanted, you wanted to have an active manager to try and beat the market and get above market returns, then you could mix it with the equity income portfolio and the equity growth portfolio that are provided to us by Intelligent Investor. Now, of course, you can mix it with any other fund manager out there as well and keep that as your core. But a lot of our investors, what they do choose to do is get the core growth portfolio or the diversified income portfolio and then pair it up with one of these higher performing, but of course higher risk, direct equity portfolios. In these two portfolios, we're holding about anywhere from 20 to 25 stocks, handpicked by our Intelligent Investor equity team. And of course, it's going to be holding 20 stocks is going to be much more volatile than holding 200. So it's more volatile, but with more, we do anticipate higher returns over time from those portfolios. Now, what some people do, and what I myself have chosen to do, I've got the equity growth portfolio, and I've paired it up with just the international equity portfolio from InvestSMART. Okay, so I'm happy to take that extra risk, and so I've gone on and gotten the equity growth portfolio, so those 20 to 25 stocks managed by the Intelligent Investor team, and then for diversification, I've added on just the InvestSMART international equities portfolio. Okay, so you can mix and match just like that. You can build your core growth portfolio, but using the Intelligent Investor side of things as the ASX exposure, and then you can dial up and dial down the property and the fixed interest and the international exposure by using the other portfolios to suit your specific risk appetite. So I hope that makes sense. But if it doesn't, do send me an email or ask a question, and I'll do my best to clarify there. Now, I've mentioned the word separately managed account quite a bit. So on this next slide, I just want to let you know why specifically we have chosen to run these portfolios in this format. Now, what a separately managed account is, it's very similar to a managed fund, except with a managed fund, you don't get to see all your holdings and you're in a pooled investment. So a separately managed account, you're actually in your own individual little buckets. So you're separated from everyone else, and your stock that we buy for you, you own. You have the beneficial ownership of that underlying stock. Okay, so when you put your funds in, we go out there and buy your stock for you. You're not buying units in a pooled investment. Okay, now the real benefit to that is when it comes to taking income. So these separately managed accounts have full flexibility for you when it comes to taking that income. Now, you can choose to have the dividends and interest earned by your portfolio paid out to you on a monthly basis. Okay, so as income comes into the portfolio, it'll be swept out to your account at the end of every single month. You can then choose to have a set drawdown on your portfolio as well, which we then of course go and rebalance your portfolio after you draw down. And so in that instance, you can select a certain dollar amount to come out every month or every second month or every 6 months. And then, of course, you can do ad hoc withdrawals as well. So as this money is coming in and going out, it's only affecting your portfolio. So if we have other clients that are sitting there not doing anything with their portfolio, then they're completely unimpacted by you. But if you're in a managed fund, so a pooled investment, what would take place is typically a fund manager in that instance would receive cash inflows when they can least spend them. So when the market's high and you can't go out there and buy stock, and they'll receive a lot of outflows when the market's low. No one wants to be invested in the market. So then, as those outflows are coming out, if that manager doesn't have enough cash, they have to sell stock in that portfolio to keep up with the redemptions. Now, you will be negatively impacted if you are sitting in that fund and you're still happy to hold, because you're copping crystallized losses on in the portfolio. Now, in the separately managed accounts that we run, if someone else wants to leave, then we sell their stock and you're completely unaffected. Okay, so that's another major benefit as to why we've chosen to use the separately managed accounts. Also, people can transfer in stock into their separately managed account. So if you've been following along the Intelligent Investor stock calls for quite a while, but you want to take a bit of a backseat from managing your portfolio and let the Intelligent Investor team do it via the growth of the income portfolio, but you already hold a number of the stocks that they own in that portfolio, well, you can actually transfer it in, and then we start managing the portfolio from there, so we don't have to knock everything down and start again. So that's another major benefit of these particular portfolios. Also, they're quite cost effective to run, hence why we're able to keep the fees nice and low. So I believe that brings me to the end of my formal presentation. I'm going to exit out of my PowerPoint here and go and see all the questions that you guys have submitted. We have a couple here. Let me see here. Bertie says, we noted that Intelligent Investor rode out the recent pullback far better than the All Ords accumulation index. Is this because the direct equities are selected with diversification in mind also? Well, the Intelligent Investor portfolios, firstly, what I want to point out to you, Bertie, is we are not, certainly not an index tracker when it comes to investing in our Intelligent Investor growth and income portfolios. We do not, we are 100% what's known as index unaware, or benchmark unaware. So we're not holding specific amounts of banks. We're not holding resources because the market holds them. We're not holding certain retailers just because the market holds them. We don't care for that. And so we're not actually, we prefer to use the term, we're not investing in the market, we're investing in individual businesses. And these will react differently to when the market does as well. Some of them, of course, will if the market gets hit, they can get hit as well. But we've got in that portfolio a mixture of businesses from small to mid to large cap as well. So if the large caps get sold off, then perhaps the small caps won't. And the big thing that affected how our portfolios reacted as the All Ords did get sold off over the last few months is the fact that the banks were hit quite severely. You saw the budget come out with that attack on the banks, or attack is their words, I should say, on the banks, where they were going to tax them higher. There was a significant pullback. Now, when the banks make up 30% of the overall index, then of course the index is going to pull back. Our portfolios are especially the growth portfolio, I don't think holds any banks. The equity income portfolio only holds 2 banks, but dramatically underweight compared to the rest of the market. So that helped us there, and it's from looking at individual businesses and looking at a stock-by-stock basis and building a portfolio like that, where we will in times be out of sync with the market, and we will say ride out a market downturn, or we might even as well, on the inverse, if the market's running, we might actually underperform it because we're, say, underweight banks. So I hope that answers your question there, Bertie. Arthur says, if I select a few of your models to create a balanced portfolio today, how do I arrange to rebalance to avoid imbalances as per your example? Arthur, there's 2 approaches. When you are setting up a portfolio with us, if you're making, doing it yourself and getting, for example, 40% intelligent investor income, 20% international, a bit of property and a bit of fixed interest, and you're actually selecting those different portfolios, there's a box that you can tick called on our application form called fixed or floating. Now, if you tick fixed, what that means is the weights that you've chosen are actually fixed. So once that gets out of sync, it'll naturally trigger a sell and a buy call. Okay, sell the stock that's overweight and buy the asset class that's underweight. So we can automatically do that for you. Now, if you don't want to tick that, and because that will happen whenever the weightings get out of sync and it goes above our minimum transaction value. So that can happen depending in a volatile market, could take place regularly. If you wanted to have more control over it, you can actually just send us in a form to go and scan it into us as and when you see it, to rebalance your portfolio. So you'll put the weights down that you want, and they could be the original weightings that you had there. Send that in and we rebalance for you. If you wanted to do that on a quarterly basis, or on a monthly basis, on a yearly basis, or on an ad hoc basis, we can take care of that. So keep in mind though, you can also tick that fixed box and we take care of it. Let's see, any more questions here? Stefan says, I've been considering investing some funds for my grandchildren to access when they're young adults. Is this SMA structure flexible enough to achieve that? Absolutely. Stefan, you can invest for your grandchildren, and you can invest in their name in the SMA structure, and it starts at a minimum of $5,000 though, so you have to reach that minimum. But we do have people that invest and open up accounts for their children and grandchildren, etc. So 100% definitely yes. If you wanted to find out more information about how you can do that, you can just email us at invest@investsmart.com.au, and we'll be able to pass that on to our actual applications and processing team, and they'll walk you through that process there, Stefan. Indiana has a question here as well. Mitchell, I've used the online tool to see what my health score would be. I invested in the core growth model. I wanted a little more growth, but I'm worried that if I add international Australian equities, will this negatively impact the balance you have created? Is that right? Well, if you go and add more Australian equities or more of the international component, you will go above, like say, the standard high growth, the standard growth health check, and of course that'll deteriorate your health score. But as long as you know and understand what you're doing and why you're doing it, if you are happy to have that higher volatility and it doesn't impact your score too much, and you're happy to write it out for the long term, because of course, think about the more growth assets you have in your portfolio, the longer your time horizon, because you will have in the shorter term more volatility, but over the longer term that volatility will smooth itself out. So just keep that in mind. Now, if you are wanting to have that a little bit more growth than say just the passive Australian equity exposure would give you, perhaps you could try playing around with that health check and the improve my portfolio section there, and put in say all of your Australian equity exposure just as the Intelligent Investor Growth or Intelligent Investor Income portfolio, and then use that satellite option. So put your fixed interest, the property and the international there as well. So you could go around it that way. So I hope I've answered your question there, Indiana. Jeffrey says, how does one actually invest, online or hard copy? It's up to you, Jeff. Both. You can go online right now. Well, you're already online if you're watching this. You can click on the investment section, hit the apply now button, and away you go. And if you've got your details with you, you'll be able to hit submit on that within under 10 minutes. And no matter if you're an individual, joint investors, SMSF as individual and trustees, or an SMSF with a corporate structure, you'll be able to invest online without any hassles. For those people who still do prefer hard copy, of course we can send one out to you. Just get in contact with us and we'll shoot it out to you in no time. Shirley says, do I need to provide trust deeds for SMSF application? In most cases when you're doing it online, Shirley, no. We have now got our system we've now got our system able to do background checks for you without people having to send in certified copies of their trust deed, which can be a pain to go and get, because normally you have to go to your accountant to actually get the copy of the trust deed in the first place. We do actually do a lookup for you and we can certify it online. So that's all part of our streamlined online process. So, but in some cases where we cannot identify easily online the SMSF, you will need to submit, we will ask you to submit certified copies of your trust deed. That's right now probably 90% of the applications though for an SMSF do not have to submit those forms. So go online, try it out. So Tommy says, hi Mitchell, I have 10K to invest for my 2 kids. Can I invest in the SMAs with this amount? Should I separate this over several portfolios or just put it in one? Which portfolio is best for a young person? Well, to avoid potentially giving personal advice here, Tommy, I'll just answer, yes, you can invest for your kids. The longer the time horizon, of course, we would say the more high growth assets you should look at, but certainly if it's a set and forget portfolio, look at a passive portfolio that you don't have to manage too much or worry about as well. So, but just keep in mind per portfolio, it's going to be $5,000 per model. Okay, so 10 grand suits fine just there, but as long as it's $5,000 per model, per investor, then you're fine. I hope I've answered your question there, and it looks like we've come to the end of all the questions. So as I mentioned, if you had any follow-up questions and wanted to have a chat, in the right-hand corner of the screen, you'll see a little green icon there. If you click on that, you can have a chat to me or any members of our team. As well, tomorrow, if you've got a self-managed super fund, do join us as my colleague Tony Kay speaks with our advisors Max Newnham and Bruce Bremmel in our live advisor Q&A. So throw him all your curly super questions. But for now, my name's Mitchell Sneddon, and I'll leave it at that. Thank you.